CNBC-TV18.
ICICI Lombard slips on missing growth estimates and taking a cautious stance on motor insurance, leading analysts to trim targets, but the company tells CNBC-TV18 it will gain from the new IRDAI expense norms.
Glenmark Pharma perks up after it settles an antitrust drug matter for $48 million, while Piramal Pharma gains on successful completion of a US FDA inspection of its US Sellersville unit.
Strong growth in China's auto sector drives metals higher, with aluminum seeing strong gains overnight. Good afternoon. You're watching us here on Halftime Report. I'm Manglam Malu. With me, Sonia Shenoy. Sonia, it's halfway through the trading session and we haven't moved an inch from the markets. I mean, 17,650, that's where someone's put Fevicol, I guess.
It's a comatose market, right?
Comatose
That's the only way to put it. I mean, there's no action at all through the course of the day so far. Hopefully things will pick up. But I think no action sometimes is good because the market is, doesn't want to see any major downside. There are no great triggers as well. Upcoming in the next few days, you'll have some large Nifty companies coming out with earnings as HCL Tech tomorrow. Then we wrap it up with the Reliance on Friday, ICICI Bank on Saturday. So yes, we have many big triggers, but in the interim, not too much happening. And a couple of stocks actually that I want to mention. Today, some of the auto stocks are doing pretty well. So Bajaj Auto is topping the charts. M&M, Eicher Motors are all in the green. Reliance also ahead of its numbers is not looking too bad. So there's some traction that we're seeing over there as well. But let's talk about individual names. ICICI Lombard is trading lower after reporting its fourth quarter numbers. Surbi is here with the highlights.
Thanks so much for that. So ICICI Lombard will be in focus today. That's because the earnings were a mixed bag. The GDPI, which is the gross direct premium income, missed estimates, but the PAT beat estimates, and that was largely due to higher investment income. The GDPI was up 7% on a year-on-year basis. The net earned premium was up 12% on a year-on-year basis. The combined ratio also remained elevated at 104%, which was in line with the estimates. The company continues to guide a combined ratio of 102% by FY25. The claims ratio was also higher than estimates, and that was due to higher claims ratio in the motor third-party portfolio. The management continued to remain cautious in the motor business given the competitive intensity. Now that, combined with the regulatory requirement of bringing down the stake of promoter entity ICICI Bank, continues to be an overhang for the stock. Brokerages also have a cautious view on this. Jefferies has a buy rating, but they've cut their target price to 1560. They say for FY24, you have to watch out for the rise in cost of reinsurance and also how industry adapts to the expense of management rule. They trim their estimates by 3 to 5%. They further say that the stake sale and the CEO succession may limit the re-rating of the stock. JP Morgan has a neutral rating, but they've cut their target price to 1160. They say the motor portfolio is likely to remain competitive, and the comprehensive product portfolio, which is P&C, may see lower profitability due to increase in reinsurance rates. They don't have the visibility to price in a beat of the management guidance of 102% of combined ratio by FY25. Additionally, Morgan Stanley has an overweight with a target price of 1400. UBS has a buy rating with a target price of 1445, and Nuvama is the lowest amongst all. It has a hold rating with a target price of 1200.
All right, Surbi, thanks a lot for that. In fact, we also got in touch with Gopal Balachandran, who's the CFO and Chief Risk Officer at ICICI Lombard, and he outlined the measures of the company which they were taking to bring down the combined ratio. Also believe that they can outpace industry growth going ahead. Let's hear him out.
So there are multiple levers that we kind of work with. Clearly, in terms of increase in pricing is one of the levers that we kind of largely look at. For example, on the retail health, this February we have kind of effected a price increase of about 19% on the renewal part of the health segment. So therefore, pricing is definitely one of the levers that we have. We equally look at actively focusing a lot on claim service efficiency, because that typically forms the bulk of the combined ratio breakdown if you were to look at. And third, and more importantly, we will continue to make our investments in various areas of expanded distribution, but early signs of success of those investments translating into incremental revenues is already something that we are seeing. Over the last 15 years, the market has compounded at 15%. And given the opportunity that one is seeing, even in terms of the road forward, particularly when you look at, let's say, FY24 or beyond. We believe the market should continue to grow in the range of 15 to 20%. And from an ICICI Lombard standpoint, we would obviously want to see a similar kind of maybe beating the market by maybe 1 or 2 basis points over the market growth rates from a revenue perspective.
Okay, let's get you some more earnings commentary that came our way now. Angel One reported a strong set of numbers, if you remember, yesterday amidst the volatility in the capital markets. Earlier today, we spoke with Dinesh Thakkar, the chairman and managing director at Angel One. He mentioned that the company plans to focus on market share and not on the cost-to-income ratio. Let's listen in.
We are not focusing more on improvising our cost to revenue ratio, because we want to focus more on market share. So this time it was better because there was one reversal of ESOP cost, which was not a big amount. But primarily what I wanted to say is that we are into kind of an investment mode, where we would be focusing more on getting market share or getting more wallet share from a customer. Impact on our profit and loss would be around 40 crores because we have to raise more capital. What I believe this industry would be growing at a far more better rate than what it was in FY23. FY23 was very lackluster year. So I'm expecting this growth would be better next year. And based on that, I'm expecting industry is going to grow higher than what it grew last year. And always we have been gaining market share. So overall, I see a lots of kind of like positive growth in coming years also.
All right, so that's about some commentary coming in from the management of Angel One. Meanwhile, just keep an eye out on Zomato. That's the stock which is surging in trade today. This after the company has made some changes in the payment structure. What basically has happened, and which is why the stock has come on our unusual mover list. The company has gone ahead and made some changes to the payment structure that it has for Blinkit, and as a result of which there were a bunch of protests, etc., that took place as well. But now the company has gone ahead and formally announced to the exchanges that they've made changes in the delivery partner payout structure, and this is with regards to Blinkit in the last few days. And all the stores of the company have resumed operations, and on an overall basis, they had to ensure some stores would have been shut for a few days, but now they've resumed operations. And on an overall basis, currently the impact of these shut stores is less than 1% of the company's revenue, which is why they did not disclose it to the exchanges in the first place. However, the change of the payment structure is a big positive for the stock, and this is as per ICICI Securities, because what the payout structure has changed from is earlier it was a flat 25 rupees per order that they would give to the delivery partners. Now it has been changed to a variable, semi-variable, 15 rupees plus 15 rupees per order flat, plus a percentage depending on the distance that they will deliver to. And it was this that everyone was protesting, but the company believes that this change in payout structure will allow them to expand their delivery radius and pay out to the delivery partners on basis the distance that they cover. And at the same time, ICICI Securities believes that this will increase the network coverage of Blinkit itself without any further incremental capital expansion. So as a result of which, this could be a positive for the Blinkit business. But by and large, brokerages have been positive on Zomato. A couple of days ago, we got a Motilal Oswal initiating coverage as well. They have a target price of 70, believing that the drivers for the food delivery industry in India are fairly structural and they can see a 19% plus growth. So important development for both Blinkit as well as Zomato.
Okay, we'll keep an eye out on that. But Glenmark Pharma and Piramal Pharma are both buzzing in trade on the back of news flow. Ekta is here to tell us all about that. Ekta, over to you.
Thanks for that. Well, I'll start with Glenmark because that stock is in focus on the back of a bit of news. So Zetia is basically a drug which is used for the treatment of cholesterol. And what has taken place is that in a pending antitrust and consumer protection litigation in the US on Zetia generic, Glenmark was named as a defendant. So what has taken place is that the company has agreed to enter a settlement with a group, with a party which was litigating against Glenmark on Zetia generic. As per the settlement, the company is going to pay $48 billion to direct purchasers, which is basically the group which is a part of this litigation, based on the agreement entered. The trial, remember, for this case was scheduled to begin on April 19th in the US courts. Now, just to give you a bit of a background as well, there have been multiple lawsuits in the US in connection with generic Zetia all the way since 2010. Lawsuits allege that the company had entered into an anti-competitive agreement. So there was a pending lawsuit with regards to Zetia generic, which is now settled, and the company is going to be paying $48 million in terms of the settlement. It does come as a positive because there's an overhang which is out of the way, and this is a generally a normal course of business for most pharma companies. Remember, the amount which we've spoken of is not that large in terms of a sum, so hence maybe the street has brushed it off. Glenmark is anyway close to a 52-week high. Piramal Pharma is in focus because the US FDA has concluded the inspection of the company's Sellersville manufacturing facility. They've issued an establishment inspection report, which means that the inspection has concluded successfully. Now, this is important because this has been one of the USPs for Piramal Pharma, that they have an excellent track record when it comes to the US FDA. They in fact have closed all 4 US FDA inspections since November 2022 successfully, which includes the Digwal facility, Riverview, Lexington, and now Sellersville. So this is definitely a positive for Piramal Pharma. Remember, the stock is also corrected very significantly from that listing price of around 200 rupees odd last year, and maybe there is some amount of value buying that the street is recognizing with regards to their track record.
Okay, thanks a lot, Ekta, for that. Let's slip into a quick break. On the other side, we'll focus on more stocks that are moving on the back of news updates. We'll get you an update on the market as well. Stay with us. Welcome back to Halftime Report on CNBC-TV18. Well, for now, just a couple of more updates on the market. Let's take a look at what's the big buzzers this afternoon. There's pharmaceutical stocks which are topping the charts. So Divi's Labs is up over 2%. In fact, this month has been great for pharma names. Divi's has actually put in 20% this month already. It's a big comeback over there. And a couple of other pharma names as well, since we're talking about big monthly gainers. There's Dr. Reddy's too, which has gained almost about 8% this month. So big moves coming in the pharma space. But Titan is in focus after Kotak Institutional Equity says that their industry interactions indicate the company has reduced franchisee commissions from Q1 of FY24. What does this mean for the business? Of course, the stock is under a bit of pressure right now. But what does this mean?
Well, the reason why the stock is under pressure is perhaps because of high gold prices and uncertainty over demand going forward. But what this news is positive from the company's operational standpoint. What they've basically done is the kind of commissions that they give to all the franchisees, they've reduced that for older franchisees, which is basically tier 2 franchises, which is owned by the company and operated by franchise stores. They've cut it by about 50 to 60 basis points from the 5% that they give right now. And for franchisees which are owned by the franchise owners and operated by them as well, they get about 10% commission. That has been reduced by about 100 basis points. This happens over the next couple of years. Kotak believes that this would improve their standalone EBIT margin by about 50 basis points over the next 2 years on a blended basis. And there wouldn't be any opposition coming in from any of these franchise owners as well. In fact, the company had gone on this cost-cutting spree just before the pandemic hit, and that's helped them. Going forward, this will help them further tighten the leash on overall costs. That's as far as the operational performance is concerned. But remember, from a stock market standpoint, the big valuation driver for them, which comes as a surprise, is from CLSA, where CLSA believes that their non-jewelry business is now scaling up fast. And as a result of which, as the first part of their analysis of their non-jewelry business, they've ascribed value to their eyewear business. They believe eyewear business can grow extremely fast, set for a rapid scale up. And they valued the eyewear business to about, almost $2 billion, which is close to 15,000 crores. This is something, here on CNBC-TV18, we had pointed out about 2 weeks ago when ADIA invested in Lenskart. When looking at these valuations, people will now start ascribing value to Titan's eyewear business, and CLSA has been the first brokerage to do that. And as a result of which, they've raised their target price to about 3150 odd as well. So these are both positives. However, the near-term gold prices could impact them.
Okay, well, lots more data points coming in. BEML land assets have listed at 292 rupees a share, clearing the path for a partial divestment of the government stake in BEML. Vivek is here to give us the latest on that. Vivek, what are you picking up?
Well, absolutely. So, now 2 companies, under that particular name itself. So the company that listed today is BML Land Assets Limited, and it's actually been quite a bit of a subdued listing. The price discovery process itself, which indicating a price of 290, that itself was well below what the street was anticipating, and after that there's been quite a bit of a sell-off on the stock price as well. What does the company own? As the name suggests, this particular company has all of the land bank that BML held, and almost, when you're talking about 550 acres of land, the company holds in Bangalore as well as in the Mysore markets. Remember, last year, towards the end of last year, BML shareholders received shares of BML land assets value in the ratio of 1:1, and it's been quite a long time that they have been waiting for these assets to get listed. So now what does this mean for BML itself? BML clears the deck as far as the privatization that the government intends to do. Remember, the government owns almost 54% in BML and is looking for a strategic buyer for a 26% stake. So now, as per analysts, the next step would be invitations of the EOI and going forward with the privatization as far as BML is concerned, which is why both of these stocks are in focus today.
All right, Vivek, thanks a lot for that. Meanwhile, just keep an eye out on United Breweries, and that's because there's been some update coming in from Heineken, which of course is the global partner. They've reported their first quarter numbers. This is the first quarter calendar year of 2023, and for us it's the fourth quarter. They've said that in India, net revenue grew by high single digit organically. Revenue growth was driven in India by both volume growth as well as pricing. Beer volume grew by mid-single digit, led by Kingfisher. The premium portfolio in India, however, grew in high teens, led by Kingfisher Ultra and Heineken Silver. This should be a mild positive, mainly because the third quarter performance was extremely weak. We saw a sharp dip in the company's margins by almost 700 basis points. So the premium portfolio is doing well, and volumes have been growing as well as some price growth. We could see some margin improvement in the fourth quarter. But remember, fourth quarter also had an impact of extended winters, not particularly good for beer consumers. And now with the heat wave going in, maybe the current quarter that we're in right now should be good for beer consumption. In fact, it's been a very beer-heavy day, so to say, mainly because Som Distilleries, another beer company, also reported that in Karnataka, one of their facilities, they've increased capacity, and now that capacity has come on board as well. So Som Distilleries is the other stock which is doing extremely well. A wee bit of recovery from the lows on the news coming in from Heineken on United Breweries as well. Does that whet your appetite?
Well, I'm a teetotaler, so...
Oh, you're a teetotaler. Yay!
So, I mean...
Welcome to the club.
And in any case, I mean, beer is not something that attracts me. I mean, has never attracted me. So,
okay.
Well, for all the beer lovers, this could perhaps work. But moving on, JP Morgan has issued a note on Coal India and has also increased its target price. Nigel is here to tell us more on that. Nigel, over to you.
Well, that's right. JP Morgan, they've gone ahead and increased their target price from around 285 to around 290 rupees odd. They're expecting the FSA coal price hikes to come about. Remember, it's been long awaited. You've had the wage increase that's come about, which dents the margins. But the FSA price increase hasn't really happened. Remember, as a percentage of their total sales mix, FSA accounts for close to around 80-85% of their total sales volume. So it's a rather important point that we're waiting for. They've given a reference point. The last time around the FSA prices went up was in January 2018. So it's been a long, long while since then. They're saying if that happens, then we are expecting stable to better than expected earnings. And if that happens, then what follows is better than expected dividend. They also highlight the fact that the ESG concerns are gradually receding. As the FIs, in the last couple of years, they've increased their stake by close to around 130 basis points. So good going. Let's see whether or not that price hike does come about. Back to you.
All right, hang in there, Nigel, because Coal India is something that everyone, I mean, you've been speaking about since morning. Right now, the update that came in on Heineken, Sonia said she's, stopped drinking, so she's a teetotaler right now and doesn't drink beer in any case.
Yeah.
Here, we haven't contributed from the studio. But in your case, I mean, the first quarter of calendar 2023, did you contribute? If not, is the fourth quarter, the second quarter or the first quarter of the financial year, are you likely to contribute?
Mangalam, for a teetotaler, you have plenty of knowledge on it, right? You have mentioned the winters at the start of January, right? So it's mostly malt that goes in, just at the first half. But I think the quarter one numbers should look better. You know why?
Yeah, well, I do. And, are you saying that in the fourth quarter there was more United Spirits consumed than United Breweries?
Doesn't have to be United Spirits. It could be some other brand. But, that's the way it works. Both of you are teetotalers, so stay healthy. I'll take the load from the consumption space.
And there's so many long weekends, right? There's another one coming up. So maybe you can expect the business to go up.
That has
previous long weekend.
Brands.
No, the one that's coming has a dry day. Huh? So I just
Okay, and the previous long weekend as well, I think a couple of days were dry, mainly because there was Lent going on, so a large community wasn't consuming a lot of alcohol.
Mangalam, kudos to you, right? For a teetotaler, you have the dates in place. You know what works in which weather. I'll have to keep an eye out on you. Actually, I'm starting to doubt you.
By the way, he doesn't even smoke, and he tracks ITC, and he knows everything about the cigarette business. What's going on?
Those who don't drink or smoke are the ones who are busy reading and analyzing, reading the labels of the bottles, etc.
Not Team Mangalam.
Well, why don't we all go out and then realize who's a teetotaler, who's not, Nigel? We'll find out for ourselves.
All right, let's do that, guys.
Well, let's take a short break on that note. Lots more coming up, though. On the other side, we'll get a roundup of some interesting trends on investor behavior as well. Stay tuned. Welcome back to Halftime Report. Now, the market is very quiet, so let's try and get you some investor trends. Surbi, my colleague, is standing by with a roundup of some interesting details on investor behavior of late and what that could mean for the market. Surbi, over to you.
Well, March data from the exchanges and depositories is throwing up some pretty interesting investor behavior trends. First of all, the trend of new demat account openings is slowing down. Now, though the total number of demat accounts continues to rise at an absolute basis, the incremental new account addition is what is seeing that drop. March actually saw 19 lakh new demat accounts being opened as opposed to 21 new lakh accounts being opened in February. In fact, this trend, you can say the decline has started in January after having a decent end to the year. The number is also well below the monthly average of 29 lakh new demat account openings that we saw throughout FY22. So if you average out every month of FY22, then we were at 29 lakhs. That number for March is down to 19 lakhs. So that tells you about the pace of the decline. Now, lackluster markets are probably the key reason behind this drop in fresh demat account openings. And that could also be the factor behind the steady decline seen in NSE's total active client base, which has been falling for 9 consecutive months, according to Motilal Oswal, and it's come down to 326 lakh accounts in March. Now, mind you, even though the number of NSE active clients is almost down 9.5% in March of 23 versus last year, discount brokers aren't complaining. Their dominance actually has been growing steadily throughout the last 1 year, with the top 5, that is Zerodha, Upstocks, Angel One, Grow and 5 Paisa Capital making up now for 60% of the market share. Let's come to another interesting trend, and this is retail investors, or should I maybe say retail traders, increasing their interest in the futures and options market. Let's look at the basic turnover trends to begin with. Now, despite the market remaining absolutely flat over the last 18 months, average turnover has been pretty healthy. In fact, it's up from 95 lakh crores in March of 22 all the way up to 236 lakhs crore. That's almost 150% jump in that 1 year period. Now, this is largely courtesy the rise in F&O volumes. Let's look at the average daily turnover in the F&O segment, which is up in March 148% over last year, and it's a 13% increase compared to February 23. It's not just seasoned traders, but retail has also decided that it doesn't want to miss out on the F&O opportunity. Motilal Oswal points out that retail segment average daily turnover has grown about 12.5% in March over February, the month-on-month growth if you're talking about Feb 23 and March 23. But the more stunning comparison is on a year-on-year basis. If you look at the average daily turnover in the F&O segment, retail turnover, then we're talking about a massive jump. From a level of 40 lakh crores in March 22, that number has moved up to 87 lakh crores in March 23. Contrast this with the cash market activity, and cash market retail volumes have actually dropped in the same period, the year period, by a little over 28%, and they've come in at about 237 lakh crores. So there we have it. It's quite clear that the retail investor is willing to experiment with newer ways of making money and is perhaps heading from the cash to the futures and options market.
Indeed, interesting trends out there. So what we'll do is we'll help the new age investor and get some trading ideas on the other side of the short break. Jay Thakkar of Sharekhan will join in. Well, if you open the market right now, you would see that it has been virtually unchanged from yesterday's close. At any given point in today's trading session, it hasn't moved much beyond or around that 17,650 odd marks. So it was supposed to be a narrow range trade, and it is narrower than ever before right now. It's meandering around that 17,650 mark. It's the mid caps which are faring better ahead of the weekly options expiry. So those are a couple of things that we're watching out for in the F&O space. But more importantly, if you just take a look at the Nifty, while it is at 17,650, what's easiest for option writers is to look at the 17,650 call as well as 17,650 put, and play for the range around that. So if you were to sell both a 17,650 call and a 17,650 put, as a lot of people have been doing, you can see almost a crore shares added in open interest for the 17,650 call and a crore shares for 17,650 put as well. You would net a premium of almost 100 odd rupees, and you would be in the money so long as the Nifty did not break 17,600 at the lower end or 17,700 at the upper end, which by the looks of it right now is unlikely. Even if the Nifty was to go below that 17,600 mark, 17,600 put writers are very active for a premium of 30 rupees, and that brings in right in line with the 200-day moving average of 17,578. So not only is the market unlikely to break the 17,600 to 17,700 range, it is unlikely to go below that 17,578 mark, which is the 200-day moving average as well. That's what smart money is betting on. But given it is the mid caps which are doing extremely well today, we are seeing a fair amount of long positions being added on a couple of counters. TVS Motors is one of them. A lot of open interest addition out there. GSPL from the metals pack doing extremely well. Some long positions being added out there as well. And if you just take a look at Coromandel International, something's happening out there because the open interest on that is up by almost 11 to 12 odd percent, even as the stock is up by just 2.5%. So a lot of bullish bets being taken on Coromandel International as well.
Okay, well, let's get Jay Thakkar of Sharekhan into this discussion. Jay, hi, welcome to the show. Mangalam was mentioning TVS Motor, and that stock has had a dream run, right? I mean, it's hit a fresh 52-week high. It's been one of the strongest stocks in its sector. Do you see more upsides here?
Hi, very good afternoon to you, Sonia and Mangalam. I'm very bullish on the overall auto pack. In fact, last time when I was on your show, I mentioned that overall two-wheeler pack is looking really good, of which TVS Motors, I had mentioned that it has provided a very nice breakout technically from a symmetrical triangular pattern, and I think that going forward too, we are likely to see good upside from here on as well. So TVS Motors definitely is looking bullish, and we are seeing good derivatives activity out there as well. I mean, there are a good amount of long additions happening out there.
Okay. Any other stocks that you like? I mean, TVS Motors one, where there's perhaps long addition as well, short covering too. But any other stocks that you prefer in this market?
Sure. See, Sonia, overall the market outlook is sideways. I mean, as Mangalam also rightly pointed out, I mean, Nifty is likely to trade within this range of 17,500 to 17,800. I mean, it's a pause after a good amount of sharp recovery, I would say, both in Nifty and Bank Nifty, wherein Bank Nifty's range is 42,000 to 42,500. And whenever we see a breakout from this range on the upside, we'll see further momentum coming in. But stock specific activity is really good, and we are seeing good action out there. So I have also got a buy recommendation from the two-wheeler pack, and that's on Bajaj Auto. This stock too has provided a very nice breakout from a symmetrical triangle pattern. The stock is trading around the levels of 42.76 right now on the spot levels. My targets are on the upside 44.50 to 45.50. One can buy this with a stop loss of 41.50. And second buy recommendation is on Steel Authority of India sale. I mean, metal bag has also seen good additions today. It has many stocks have seen a good breakout coming in today's session. So safe trading at around levels of 83.40 can be bought for a target of 86.5, and one can place a stop loss here at 81.5.
Jay, have you tracked the chart activity in Coromandel International? I mean, all this year it's been extremely flat, and this morning, since this morning it's been doing well. A lot of open interest addition. Chartically, something that you can watch on Coromandel?
Yeah, sure, Mangalam. In fact, Chambal, Fertilizers and Coromandel and all of these have really seen good action in past couple of trading sessions. Especially in the case of Coromandel, wherein we have seen good long build-up. There has been a breakout from a double bottom pattern as well, above the levels of 940. So on the very immediate basis, 940 will act as a very crucial support, and until those levels are held, Mangalam, we can see the stock heading towards the levels of 970 on an immediate basis.
All right. Thanks a lot, Jay, for joining in and giving us your views on a whole host of stocks and the market itself, which you believe will be sideways. But what's not sideways over the last few trading sessions has been the pharmaceutical pack, up almost 9 to 10% from lows on the index level. A lot of individual stocks doing extremely well as well. So this morning we spoke with Gautam Shah, founder and chief strategist at Goldilocks Premium Research, and we asked him just that, his top sector bets, and he spoke about pharma.
I want to obviously start about pharma because it was a sector which was in a mega bear market for almost 18-20 months. So that index has come up really well, and I see further upside. This finally looks like a turnaround for good. There have been multiple turnarounds which failed in the last 12 months, but this turn I think looks very, very good on the charts, and I do believe that the pharma index can give you anywhere between 10 to 15% even from these levels. And on the downside, I think we are watching this important support of 17,500. So if at any point of time this breaks, I think the bears can be back. We love real estate. I think it's always was our favorite in the last 2 years. It's just that because of the market correction, the index came off. But the big boys actually, stood out. I mean, look at a DLF, look at an Oberoi Reality. Despite the market weakness, they stood out really well, and now it's coming back quite strongly. Most of the mid-cap IT stocks have actually held out. I can give you a lot of names, a Persistent, a Scient, and whole host of names which have done quite well in the mid-cap IT space. Large-cap IT has been a bit of a problem, but I see it as an opportunity for long-term investors.
Right, with that, we'll send to a short break. On the other side, we will get Abhishek to talk about the NBFC sector, what the street is expecting from that in our special segment, Quarter Say, Quarter Done.
Back to halftime report on CNBC-TV18. On to our special segment now, Quarter Se Quarter Tak. Abhishek is here today to take us through expectations from the NBFC sector in this quarter. Abhishek, what can we expect?
Well, non-banking financial companies, that is NBFCs, are expected to report a strong Q4 FY23 in terms of results, driven largely by higher disbursements and recoveries despite the potential impact of rise in interest costs or interest rates on their net interest margins. So there is a strong underlying consumption demand seen across segments of housing, vehicles and consumer durables, which is likely to support the disbursals trend for NBFCs. Housing finance companies are expected to report growth in the low to high teens with stable net interest margins, and SDFC Limited and Canfin Homes are expected to report good numbers. So commercial vehicle is the other sector which is expected to report strong growth in mid-teens, that is 15% to over 25% due to strong disbursements. Gold financiers over there, you can expect the pickup to sustain in this quarter in terms of quarter-on-quarter growth rate, with Muthoot Finance expected to report positive sequential growth, while Manappuram Finance is likely to report negative growth on a sequential basis. Consumer finance is expected to report better growth given the fact that there is improved macro seen in Q4 with no asset quality woes expected, but there may be some pressure on the net interest margin. So according to key estimates by Antique, HDFC Limited is expected to report net interest income at about 4,929 crore, which is up 5.1% YOY and about 0.3% sequentially, and they are expecting profit of HDFC Limited to be up 1.1% YOY and about 1.4% sequentially. For Bajaj Finance, they are expecting net interest income growth of about 26.9% YOY and 3.5% quarter-on-quarter, while profits of the lender is expected to grow at more than 26% YOY and about 2.6% sequentially. For Cholamandalam, Antique is expecting net interest income growth of about 20% YOY and 1.7% sequentially, while they are expecting the bottom line growth of 0.3% YOY and about 1.1% sequentially. For Muthoot Finance, Antique is expecting net interest income growth of about 10.4% YOY and about 10.6% sequentially, while profit is expected to decline by 0.4% YOY but be up about 6.1% quarter-on-quarter. Back to you.
All right, Abhishek, thanks a lot for that. A strong footing expected from all the NBFCs in this quarter. With that, we'll slip into a short break and finish our coverage on the equity markets, because on the other side, we have Manisha Gupta joining in as always, discussing commodity space. And today she has rice on her mind.
Welcome back, and joining us on the show now is Himanshu Agrawal. He's director at Satyam Balaji Rice Industries. Himanshu, hi, thank you so much for joining us. And rice clearly is on headlines today. We, of course, were reacting to the higher export numbers of previous year that got delivered a couple of days ago. And then the latest Fitch report, which says that for the year 2023, the rice crop would be the lowest in 20 years. How are you reading that?
So we have expected that because the sowing numbers in Kharif was pretty low, but then you see the exact cultivation figures that we saw was quite promising. So I generally don't feel that it would be a concern wherein we would see, because the sowing figures are up about 4.4% on overall crop basis. So the report that shows that it would be lowest in 20 years, I don't know where exactly this thesis is coming from, but to our concern, the pricing and everything is well under control. So I don't see any reason for concerns in terms of rice supply is concerned.
Himanshu, that's for Indian markets, or are you talking global?
No, I'm talking globally. I don't think there should be a concern, because we are not seeing much of demand coming in from the African markets or the Southeast Asian markets. The prices are well under control. So any panic buttons to be pressed right now, that's not how I see it.
All right. Himanshu, the Fitch report also says that, one, it is about the Ukraine war, where Russia, of course, is not coming out with very supportive statements there. And then the weather concerns in Pakistan, China, even lower crop in US and Europe is where they see concern coming in from.
So Ukraine was not really in picture in terms of rice global market, and in terms of US, if we talk about their import figures have been down from last year. So I would only see a concern if in case we see Thailand or Vietnam coming into picture with a crop concern, which so far has not been the case. We are seeing consistent supply from Vietnam and Thailand, which are the two other strong suppliers in global rice market. And as far as China is concerned, their rice consumption more than human consumption, it is for feed. So their feed market has alternate crops like maize, like soya meal. So I don't know. I mean, how exactly would China react to it? But otherwise, I would see there is a steady price wise, and the sanctions that India has applied on broken market supply and the duty on white rice are helping to keep the market under check. So so far as bullishness in terms of pricing or any concern in terms of supply as we would see it, that's not really a concern. And if you see the Indian government stock situation right now, that's pretty healthy as well. So, and the export figures that you're talking about has been higher side is all because of the spillover demand that we are seeing because of the restrictions put in by Indian government. So once this neutralizes, as we see right now, the exports are slipping. as compared to 15 to 20 vessels that we used to see on rice on any given point in time last year, which has now come down to 5 to 10 vessels. So on month basis, if you would see Feb 2022 versus Feb 2023, the numbers are, well under control.
So, Himanshu, you're saying that the Fitch report, as of now, needs to be taken with a pinch of salt.
Yes, I mean, indeed it should be, but in terms of global supply, there's absolutely no panic button that one should be looking at. As a matter of fact, we are rationing and we are talking to Indian government in terms of how we can restart the broken exports and, how it is discouraging the Indian white rice market on which they have imposed 20% duty, because we are constantly seeing that we are getting the price disadvantage and we are not as competitive as we were in terms of African market, because Thailand, Vietnam, and other countries are, they are being very, very competitive after the duty has been imposed.
Himanshu, last year's export numbers came in quite strong, 16% on the higher side, a record $11 billion. In sense of quantum, it wasn't so great though. Clearly, because of the price, part of it is why we see that number. What's your sense for the new season now? I mean, as you said, you are in touch with the Indian government. There is conversation going on. What can be expected?
So we can see that, Indian rice export from $21 million, as I said last time we spoke, we're seeing it coming down to about 15 to 16 million, out of which about 4 million tons should be basmati, and the balance 10 to 11 million tons from non-basmati is what we can expect. And that too is dependent on how the quotas are released for the restricted rice categories and how the government takes their stance for the 20% duty that they have imposed. So it is contingent to a couple of factors, how Indian government overall looks towards it. So I would say that 10 to 11 million tons is what export we can look into in coming years. And as you see the figures of $11 billion, what you see, a majority of that comes from Basmati sector, because their prices are almost 3x of what non-Basmati prices are.
Himanshu, also a final question. So what's your sense on prices going forward? I mean, global prices have been all right. The Indian prices have been rising, but very gradually then. What's your sense for the, let's say, coming couple of quarters?
So we have the Rabi crop hitting us pretty soon in next 2 or 3 weeks time. So after that, we should see some softening in prices coming in terms of parboiled rice. And broken prices have come under good check because of first restriction by the Indian government, and second, we have seen softening in maize prices. So broken and maize are the kind of substitute for each other in a lot of secondary market, such as feed market, distillery markets, ethanol supply. So I would see that in short term, we see stable to bearishness in the prices. In next 3 to 4 months is how I would like to, assess the market.
Okay, we will let you go on that note. Thanks a lot for that. So that's a word on the global rice shortage. Thanks a lot, Manisha, for joining in as well. Well, we wrap the markets, which is so quiet. I haven't seen this kind of a move in many, many days, where the needle has barely moved about 20-30 points through the course of the morning, just fixated at one point for the market. But I guess this is how consolidation phases look. Let's wrap up the show on that note. We leave you with some opinion on China and the Indian market by Mark Matthews of Bank Julius Baer & Company. Listen in, Business Lunch is lined up in just minutes from now.
Numbers that came out of China show their recovery is indeed happening, and it's strong. And that's important, because I think the market was uncertain about China. They never got lots of stimulus checks in the mail. So we increased our GDP forecast for China this year from 5.3 to 6%. And I noticed that the big investment banks also upgraded their GDP for China. So that provides a very nice tailwind to the world, particularly the world outside of the United States, places like Europe and Southeast Asia, which depend a lot on China. Longer term, India is our structural bet in the emerging markets, and all the usual reasons that I won't bore you with in detail, but the demographics, the structural reforms, the move up the value-added ladder, all of those good things. And actually, having not really done anything for 18 months, the valuation in India isn't expensive either. It's come down to its average versus emerging markets.
पिछले 6 सालों से हर रोज यही हो रहा है।